Hi, in this video I'm going to be talking about the Head and Shoulders pattern. Now the Head and Shoulders technical pattern is traded as a trend reversal signal. So let's say we have an uptrend, all right? So we have a high, a pullback, and now we have a higher high. What happens is price will tend to maybe pull back to a certain level. Then prices will fail to make a new high, because this would be the high, this would be the higher low, and this would be the higher high. When prices fail to make a new higher high, this is where traders will look to trade this type of pattern. Now, if we look, this would be what would be considered a left shoulder. This would be considered the head, and this would be considered the right shoulder. So that's pretty much where the Head and Shoulders pattern gets its name. So what we want to do is look for a change in the actual trend. So if prices are failing to make higher highs, the right shoulder will indicate that, and we're looking for a trade to the downside. And this is just in an uptrend. And what a Head and Shoulders pattern also consists of is what we would call the neckline. Now, the neckline is drawn from the left shoulder higher low, or the pullback, to where the right shoulder begins and starts to fail. Right? So when I say starts to fail, prices are failing to make a new high. Now again, this is just the perfect Head and Shoulders pattern I'm drawing for obviously illustration purposes. But on a price chart, it won't look so perfect. But you'll get the idea, and we'll go through some examples in a bit. So traders will look at this pattern here: higher highs, higher lows, then the failure of a higher high to be made, and then they will look to trade a break below the neckline. So the neckline connects the left shoulder's low, and then really the head shoulder's low, and then once prices fail to make a higher high, or look like they're not making a higher high and start to come down, this is where traders will look to get short. So in the real world, as I was saying, prices are never perfect. A Head and Shoulders pattern, the neckline on a Head and Shoulders pattern, can sometimes look like this, and more than likely will look something like this. It won't be a horizontal, I say it won't be a horizontal, but it can be traded as a horizontal level, the neckline, or it can be traded as a diagonal neckline. So you may get something like this, where prices are making higher highs, higher lows, and then you get a pullback, you get a failure on the right shoulder, and then what traders will do is look to trade the break of this level. So depending on where prices pull back to, if prices pull back to here, then traders will trade this as the neckline. This is the neckline. And the neckline acts as a type of support in a bearish Head and Shoulders pattern. And this is a bearish Head and Shoulders pattern because this is an uptrend. Left shoulder, obviously head, and prices are making, this up move. And so traders are looking to get short. So this would be what would be considered a bearish pattern. So this neckline can either be a diagonal or it can be horizontal, and there are even sometimes where traders will trade the neckline also to the downside depending on how far this move has come down. So what you want to do is always connect the left shoulder with the head's pullback, and then the failure for price to move higher than the head, and then be on alert. This is where you will be on alert when prices are failing to make a higher high, prices are weaker, the trend may come into some sort of consolidation or reversal pattern. Connect the neckline and then look for a break of the neckline. So let's have a look at this in a real world scenario on the price chart. So here we have the pound Japanese yen 30-minute currency pair chart, and we have a clear level, well, higher highs and higher lows being made. So we got a move up, we have a pullback, we have another move up, so that's your higher high. This would be considered your left shoulder. So let's delete that. So this would be the left shoulder. This would be considered the head. And then as prices have come back down in, the trend hasn't been broken yet. So we still, this is where the low is of the left shoulder, which hasn't been broken. So traders will more likely to see that this is maybe just a deeper pullback into a certain level, and then we have a move up that fails to make a new high, and then this would be considered the right shoulder. So we have the right shoulder. Now this is the neckline, right, which connects the left shoulder's low, and then we have, if we zoom in a bit more, then we'd have the head's low, and what traders will do is connect those two lows. So let me get a better tool. Let's get the ray tool and turn on my magnet tool, and this would be the level of the neckline. So traders will be on alert once prices fail to make a new high and prices start coming down. The right shoulder becomes more evident, and then we have a break of the neckline, and traders will enter short. Let me get my risk reward tool, short position on the close of the candle. Now, where do traders, or where will traders place their stop loss? Probably behind some swings. So you can see that prices have come down, made a little swing here, or above the right shoulder or above the head, depending on their risk tolerance. I mean, some traders may even just put their stop loss maybe just above even that candle's high, right? But for the safest place, it's recommended pretty much to put it at least above a recent swing, this being a pullback, this being the up move, and then the down move here. So this would be the most recent swing, or the right shoulder, or even the head if you have a longer term view and your account is big enough to absorb maybe the 80, 90, 100 pips. I mean, this is the the British pound Japanese yen pair, so risking around 100 pips on this is actually quite normal, depending on the time frame that you're trading. And obviously you go for your risk reward 2 to 1. Now, another thing I wanted to also point out is another way that traders will enter if you didn't necessarily want to get in on the break of the level because maybe your risk reward is a bit too much, would be a retest of the neckline. All right, so the neckline is would in a bullish in a bearish head and shoulders pattern, the neckline would be considered a support level that breaks and now becomes resistance. Right, it has a good chance of becoming resistance. So if your risk reward was a bit too much, as far as your risk was a bit too much, what you would then want to do is, or what you may want to do is look for a retest of the level and look for some sort of bearish price action. And as you can see, you had 1, 2, 3, several chances to get short on the retest of the neckline. So prices ended up pulling back to here. You may not have seen a bearish engulfing or a bearish pin bar at this level on this time frame. Maybe on a lower time frame, on a 15-minute, a 5-minute, this may have looked quite bearish. But then you do get this pin bar here. You also get a type doji candle. You get another rejection here, and you even get another, you get an engulfing candle here. So again, with the protection of a support term resistance level, you have a better risk reward, so you can actually get or look to run the trade a lot longer, risking smaller trades. Sometimes obviously you may not get the pullback. This may have been the entry and prices could have moved pretty much straight down, could have just went and continued going, and you may not get a retest straight away. Eventually prices may come back up to this level as well, and it may give you an entry. There are always pros and cons with a more aggressive entry or a breakout right here, as maybe compared to a more conservative entry. If you're looking for a pullback, you obviously that's up to you, what type of trader you are, but you do have options when it comes to entering the head and shoulders pattern, either the aggressive entry, the break of the neckline, or wait for a retest of the neckline. And what I'll do is I'll also go over a bullish head and shoulders pattern, so it'll be the reverse of the bearish head and shoulders pattern. So here we have the euro dollar currency pair on the daily time frame chart, and we're looking for a bullish type head and shoulders pattern, and that would be the reverse of what we spoke about previously. So we're looking for a reversal of a downtrend, looking to be a buyer this time rather than a seller or shorter. So what we have is a really clear move down here, right? And if you're using the TradingView platform and you go to here, they actually have created a head and shoulders pattern, right? So click on the head and shoulders pattern if you're using TradingView. If not, I'll go over this again, without the head and shoulders pattern tool, so you can see. But if we do click, and it has start of the left shoulder, we have a low, we have a pullback. Now the creation of the head, this would be the new low, and then we have a pullback. Then we have the right shoulder, that would be the low, and we can see that it creates the neckline as it goes. So as prices break the neckline, we have our bullish head and shoulders pattern. Now, as I've said before, the safest place really, if you're trading any kind of head and shoulders pattern, would be to put it really below or above the right shoulder or the head. If you're worried about pips on a daily time frame chart, maybe you shouldn't be trading the daily time frame chart. But the safest really area is to put it below the right shoulder or the head. So the entry would be on the close of the neckline. So that would be the candle that broke above the neckline. Notice that it's not perfect, it's not horizontal. We have a downward diagonal type of neckline. The break of the neckline, again, traders, if they would have put their stop maybe at the low or just below the low, they may have got away with possibly a one-to-one risk reward. But what you really want to do is put your stop below the right shoulder as really a minimum, to be fair. And then what we have is prices continued to move higher. And again, we had a potential retest of the neckline here. So let's say, for example, let's move that out a bit, right? So let's say, for example, you didn't get in on the break and you were waiting for a retest. This doji type candle may have been an entry, bullish doji. Maybe you would have went down to a lower time frame and seen this and maybe try to get in to the upside, depending on what time frames you do trade. So please check out our video on time frame analysis as well, and that should help with explaining how to enter using the higher time frames to enter on a lower time frame chart. But trading the head and shoulders pattern, you can see that we have a bullish reversal head and shoulders pattern in a downtrend. In an uptrend, we're looking for obviously a bearish move and get into the short side. So I hope this has been explained and you understand everything. If not, just give me an email at info@trading180.com. Thank you for watching.